Hi, my name is Mimi Maziana. So today I'm going to explain about inflation risk. Basically, inflation risk means when the price of the good keep increasing, the value of our money becomes smaller. Or in other words, our purchasing power drops. From the slide, it says inflation erodes purchasing power, reducing the real value of return. Investors should return that at least match or rising inflation. So this means even if we earn profit from our investment, the real value of the profit becomes less because everything else is getting more expensive. That's why investors always aim to get return that can at least match or beat the inflation rate, so their money doesn't lose value over time. Next, focusing on the impact on the economy and investment. For the impact part, the first one say high inflation, higher interest rate, lower security price. So when inflation is high, the central bank will increase the interest rate to control it. But when the interest rates go up, people prefer to save money instead of invest. So price of security like stock and bonds usually go down. Next, low inflation, lower interest rate, higher security price. When inflation is low, the central bank can reduce the interest rate. This makes it cheaper to borrow money and more people are interested to invest, so the price of security will go up. And the last point says mismatch between forecast and actual inflation affect market perception and liquidity. So this means if the actual inflation is not the same as what investors expect, they might lose confidence in the market. When that happens, it becomes harder for people to buy or sell their investment. We call that lower market liquidity.
This part focuses on how inflation impacts our investment decisions. So inflation is the key. Firstly, we need to track inflation specifically by looking at price changes in essential goods like groceries and food. This gives us a real sense of its trend. The reason is inflation significantly influences interest rates and security prices like stocks and bonds. As inflation rises, interest rates often rise, which can depress bond prices and change stock market valuations. Besides, central banks consistently intervene in the financial system. Their primary goal is to maintain a stable financial system. They often use tools like adjusting the key interest rate to manage inflation and keep the economy running smoothly. Lastly, as an investor, must track inflation trends because it's a major factor in how high-level interest rates are set, ultimately guiding us toward better investment decisions.